You want things in life: a good phone, your favorite coffee, maybe even a better car than the one your neighbor drives. But have you ever wondered how all those things reach you? Behind every product you use, there's a system that creates it, sells it, and convinces you to buy it. That system is called business. Business is the machine that turns ideas into products, products into money, and money into even more products. It's the reason you can order something online and receive it the next day. It's why stores carry dozens of different options for the same product. At its heart, business follows a very simple rule: make something valuable, sell it for more than it costs to produce, and keep the remaining amount. That remaining amount is called profit. Profit is the main reason businesses exist. Without profit, a company becomes a hobby, a charity, or eventually goes bankrupt. Every business, whether it's a small local shop or a global corporation, runs on the same equation: revenue minus costs equals profit. Revenue represents the total income generated from selling goods or services. It's often called the top line. But revenue is not the same as profit. It simply shows how much money comes in. Costs include everything a company spends to operate. This can include raw materials, employee salaries, rent, marketing, technology, and taxes. Once all these costs are paid, the money that remains is profit. This is known as the bottom line. Even though the formula sounds simple, running a business is much more complicated. There are many different ways companies generate revenue and just as many ways they can lose money. Let's begin with revenue. Revenue represents the total income generated from selling goods or services. Large companies earn enormous revenue numbers every year. However, high revenue does not automatically mean high profit. Businesses also earn revenue through different types of business models. One common model is business to consumer, often called B2C. In this model, companies sell directly to individual customers. Examples include online stores, streaming platforms, and local retail shops. These businesses usually have quick purchasing decisions and rely heavily on marketing and branding. Another model is business to business, or B2B. Here, companies sell their products or services to other companies rather than individual buyers. These deals often involve larger contracts, longer sales cycles, and strong professional relationships. The subscription model is another powerful approach. In this system, customers pay regularly, often monthly, to continue using a service. Streaming platforms, software services, and digital tools often use this model because it creates predictable, recurring income. There's also the marketplace model. Instead of selling products themselves, these businesses connect buyers with sellers and earn money by taking a percentage of each transaction. Another popular structure is the freemium model. Companies offer a basic version of their product for free, while charging for advanced features. A small percentage of users upgrading to paid plans can be enough to generate significant profit. Direct-to-consumer businesses follow another strategy. They sell directly to customers online, removing traditional retail middlemen. This often allows companies to keep higher profit margins. While revenue sounds exciting, costs are what truly determine whether a business survives. Costs generally fall into two main categories. The first is the cost of goods sold, often called COGS. These are the direct costs required to produce a product. For example, clothing companies pay for fabric and manufacturing, restaurants pay for ingredients, and software companies pay for servers and hosting. Lower production costs usually lead to higher gross profit margins. The second category is operating expenses, often referred to as OPEX. These include everything else required to run the company, such as office rent, employee salaries, advertising, software tools, and utilities. Some costs remain fixed regardless of sales, like rent or salaries. Others are variable and increase as sales grow, such as shipping or packaging. To understand whether a business is healthy, companies track profit margins. Gross profit margin shows how much money remains after covering production costs. Operating profit margin measures how efficiently a company manages its operating expenses. Net profit margin represents the final percentage of revenue that remains after all expenses, taxes, and interest payments are deducted. These margins vary widely between industries. Technology and software companies often enjoy higher profit margins, while retail businesses operate on much thinner margins. However, having a great product alone is not enough. If no one knows about it, the business will fail. That's where marketing comes in. Marketing is often built around four main elements, known as the 4 Ps. The first is product. A business must offer something that solves a problem or fulfills a need for customers. The second is price. Setting the right price is crucial. Price too high and customers may refuse to buy. Price too low and the company might lose money or appear low quality. Businesses use different pricing strategies, such as cost-plus pricing, value-based pricing, competitive pricing, or dynamic pricing that adjusts based on demand. The last two are place and promotion. This refers to where customers purchase the product. They could be physical stores, online websites, or digital marketplaces. Promotion is how companies inform and persuade customers to buy their products. Promotion includes advertising, social media marketing, influencer partnerships, email campaigns, and many other strategies. Marketing attracts customers, but operations ensure the product actually reaches them. Operations include supply chains, inventory management, and logistics. A supply chain covers the entire journey of a product, from raw materials to manufacturing, storage, and delivery to the customer. Efficient supply chains help businesses reduce costs and improve speed. Inventory management is also critical. Too much inventory ties up money in unsold goods. Too little inventory means missed sales opportunities. Businesses also track customer acquisition cost, or CAC. This measures how much money is spent to gain a single new customer. Another key metric is lifetime value, or LTV. This estimates how much revenue a customer will generate during their entire relationship with the business. For a business to be sustainable, the lifetime value of a customer must be significantly higher than the cost of acquiring that customer. Once a company finds a successful system, the next challenge is scaling. Some businesses grow organically by attracting more customers and increasing sales over time. Others raise money from investors to expand faster, trading a portion of ownership in exchange for capital. Companies may also grow through acquisitions by purchasing other businesses. Another strategy is franchising, where entrepreneurs open new locations of an established brand and pay fees to operate under its name. Despite their size and complexity, even the largest companies follow these same principles. They create value, sell products or services, manage costs carefully, and continuously attract customers. Business may look complicated from the outside, but in reality, it combines three main elements: numbers, human behavior, and execution. When these three elements work together effectively, ideas become products, products become revenue, and revenue turns into profit. And that is how business works from beginning to end. Drop a comment. What topic should we explain next? Thanks for watching. See you in the next video.